Hey, what's up, homies? Matt Lurker here. It may not be a buyer's market right now, but sometimes there's just nothing you can do about it, and you end up having to purchase a new home. Today, I'm talking about whether you should go with a 15 or 30-year mortgage, which one's gonna save you more money, and which one might be right for you depending on your situation. And I'm making this video during July of 2021, but if you're watching this in the future, don't click off just yet because these things will always be relevant, no matter what's going on. So first, we'll go through the structure of how these loans are set up, and then we'll talk about the benefits, the pros and cons of the 15 versus the 30-year mortgage. And I'll just spill the beans right now. I will almost always recommend a 30-year fixed rate mortgage to someone rather than a 15, even though you spend less with a 15. And I'll tell you about that more later. And just as a caveat, before getting started, every loan can be structured differently, and your loan may be different than what I talk about in today's video. That's okay, because no matter how you get there, in the end, as long as we make our payments on time, we're all gonna end up owning the home and everybody's happy at the end of this. Okay, so first let's just talk about the structure. In its simplest form, a mortgage is just a loan on property like a house, townhouse, condo, apartment. In general, it's probably somewhere where you live. And just like any other loan, you pay off the balance of the amount borrowed plus a little bit in interest every month. And while your payments may be the same size or the same amount every month if you have a fixed rate mortgage, the amount that you're putting towards interest and the amount that you're putting towards the principal balance on the loan will be different every time. And unless you actually call the bank, or if they have a great app or website that shows you the breakdown of your payments, you'll never actually know the exact split between principal and interest at any given time. But like I said, the split between principal and interest payments are going to be different for every payment throughout the loan. In general though, in the beginning of the loan, you're mostly going to be making payments towards interest rather than paying off the principal balance and gaining any equity in the home. The makeup of your payments over time usually looks something like this, where in the beginning, the vast majority of your payment isn't actually earning you equity in the home, but is paying off the interest to the bank. This works out in favor of the lender because they're making their profit on the front end of the deal while you're gaining ownership of the house on the back end of the deal. And this sucks as a buyer, but if you think about it, it makes sense that it's done this way. Because from the bank's perspective, they're taking on a huge amount of risk for every dollar that they lend to you because you may not pay them back. For the bank to lend their money to you, they're taking on a huge amount of risk with every dollar that they give to you because you may not make your payments, and at the end of that, they may have to go through the costly foreclosure process with you. And they can do all the vetting that they want to, but at the end of the day, they don't know you and they don't know whether or not you're actually going to pay them back over the course of the next 30 years, or whether you're just going to skip town and they'll never hear from you again. Since they're the investor here by loaning you the money, they want to make as much of their money back up front as soon as possible. That's why the loans are structured this way. And if you end up not making your payments, they'll repossess the home later and auction it off to the highest bidder, but that can be a costly and drawn out process where the home may have actually depreciated in that time. So they'd rather just get the cash flow from you rather than having to go through that process. And since they're taking on a huge amount of risk by offering you this loan, they really put you through the ringer before qualifying you for a mortgage. But the whole process is designed so they can reduce as much risk for themselves as possible. And it's not like there's much you can do about this because pretty much every lender is going to structure it this way, where you're paying heavily on interest up front and then on the back end you're paying off more of the principal. So that's how your payments are broken down, but the structure of the payment is only one part of the equation here. And sometimes your property taxes, private mortgage insurance, and homeowner's insurance can all be wrapped up into that loan, but that's not always the case. So check on that before signing any documents. The actual amount that you have to pay each month though is made up of three things, and that's the purchase price of the home, the length of your loan, and the interest rate that you get on your loan. To figure out what a payment will be, let's go ahead and set up a quick example and we'll look at what a payment might be if we tried to buy a house on the market today. And in this video, I'm not going to go into how to look for a good deal, how to see if something's undervalued, or how to negotiate the terms of a loan, but those things are important. For now though, let's go ahead and keep thinking about the three elements of our payments and we'll break that down further. Alright, firstly, the purchase price of a home is whatever number you and the seller agree on as the sale price for that property. This number is often different from the listing price, but usually not by much. Before the world went upside down, it was very common for sellers to accept an offer that was 10 or 20,000 less than what their asking price was, depending on where the market is that they're selling in. These days though, most homes are going for way above asking price, so it may be hard to actually find a good deal. That could be changing though, so make sure you still negotiate on the price if you can. Anyway, the purchase price is arguably the most important part of this equation, even though it is the simplest part. And as far as your down payment goes, just subtract that from the purchase price, and then we'll get the principal amount being borrowed for the loan. As an example, we'll use a purchase price of $400,000 since that's the average price of a home in the United States right now, and we'll have a down payment of 5% or $20,000. Second, let's look at the interest rate. This is going to be the extra amount that you pay on top of the principal amount being borrowed from the bank or whatever lender you go through. For our little payment example here right now, we're going to use 2.856% since that's the national average for a 30-year mortgage in the United States right now. Now the last part of the equation is the time that we're actually going to take to pay back this loan, and typically that's going to be 15 or 30 years. There are also 10-year and 20-year mortgages, but those aren't nearly as common. And obviously, the longer you take to pay off a mortgage, the longer you're going to be paying interest. But since 90% of Americans go for a 30-year mortgage, then that's what we're going to use for this example calculation. And then later on in the video, coming up very soon, I promise, I'm going to talk about the pros and cons of 15 versus 30-year mortgages. For our very simple calculation, a $400,000 home today is going to cost you about $1,600 a month just for the mortgage. Don't get too excited though, because there's a lot more cost associated with owning a home. We didn't account for property taxes, private mortgage insurance, homeowners insurance, maintenance costs, liability cost if someone's injured on your property, and the list goes on and on. But check back for a future video on all that stuff, because today we're really just talking about the mortgage itself. And at first glance, that seems pretty affordable because that's really not much more than the rent for a 2-bedroom apartment in a lot of the United States. But this calculator is not showing us the entire picture. It's doing a very good job in showing us a very visually appealing way what our monthly payment will be. But that's what we're going to pay every month over the next 30 years. And if we scroll down, we're going to see all the rates being offered to us right now to try and get us to apply for a loan. This calculator is great for showing the at-a-glance view of the numbers of our deal, but if we want to really look at the details of what we'll actually be paying over the course of this loan, then we need to look a little deeper. But before we do that, it would mean a lot to me that if you've made it this far, go ahead and like the video. It really does make a difference on how YouTube promotes videos on its platform, and that's all I'll ask of you. I'm not going to ask you to text out a link to your friends or share this video on Facebook with your grandparents and everyone else. I'm not going to complain if you do, it would just be kind of weird. Okay, so let's get back into the nitty-gritty details of our little example here, and then I'll tell you which mortgage might be right for you. That first calculator was great, but it doesn't tell us how much we're going to be paying in interest over the life of the loan, how much we'll pay in total, or how the payments are broken up. For that, we'll need to look at a more complex calculator like this. For our example, I plugged in those same numbers, and firstly just notice that the amount of the loan isn't a typo, but the amount being borrowed equals the purchase price minus however much you pay as a down payment. So in this case, that's $400,000 minus $20,000, giving us $380,000 as the amount being borrowed. And now we can see right off the bat that this loan is going to be expensive, and the other calculator didn't say anything about that. Even though the house that we're buying is only actually worth $400,000, we're going to be paying to the bank a total of $566,185. That's huge. That means that we're going to be paying almost $200,000 just in interest. That would be like buying this house and then another small house on top of that if we had used cash instead. These are the numbers that the bank doesn't want you to know, because then you'll think twice about whether or not you actually want to take on this massive financial obligation. So it's important to run the numbers yourself to really get an idea of how much this will actually cost you. And just as a quick reminder of what I said earlier, your first payment is made up of mostly interest. And your last payment is made up of mostly principal. Like I said earlier, and as you can see now, as time goes on, your payments start to be made up of more principal than interest, where at the end, it's almost entirely principal, and at the beginning of the loan, it's mostly interest. Now, we've talked a lot about the payment, how the loan is structured, and that it's important to find a good deal. But let's go ahead and take a deep dive into the differences between a 15 and 30-year mortgage. And you might find that one of them has some major advantages for you. And these two loans are structured pretty much exactly the same way, except for the time that you spend paying them off. Neither one of them has some special clause where if you're under 30, then you pay less interest. Or if you go with a 15 versus a 30-year mortgage, then you get special discounts at local restaurants. It just doesn't work like that. So I'm really just going to outline the pros and cons of both, and then I'll let you decide which one is best for you. Okay, so starting off with the 15-year mortgage. Only 10% of mortgages written are actually a 15-year mortgage, but it does carry some major advantages over the 30-year mortgage. The biggest of them are that you pay off your loan in half the time and spend way less money doing it. And by way less, I mean like hundreds of thousands of dollars less. Remember our payment example from earlier in the video? Yeah, just in our made up example, if you went with a 15-year mortgage versus the 30-year that we were talking about, you'd be spending a total of only $87,000 in interest payments over the course of the entire loan, which is a difference of $99,000. You'd literally save $100,000 by going with a 15-year mortgage versus the 30 that we were talking about. And the savings are even bigger if you have a higher interest rate or if you're paying off a more expensive home. All those savings do come at a cost though. The monthly payment on a 15-year mortgage is usually 38% higher than its 30-year counterpart, which is a huge strain on most people's budget. A 15-year mortgage can be a great way to force yourself to save money though, as the alternative is getting foreclosed on. And even though the payments are so much higher on a 15-year mortgage, you typically get a lower rate from the bank because these loans are seen as less risky for them to give to you. From the bank's perspective, the longer that they're loaning you the money for, then the longer that they're being exposed to the risk of you not actually paying them back. So it's safer from them to write this shorter loan to you. But in my mind, I think that the 15-year mortgage can be so much more risky to the consumer or the home buyer because now you're locked into this higher rate with no other option but just to pay it. But just because you think that you're a responsible homeowner doesn't mean that you're going to be immune from financial hardship. If there's one thing that you can count on, it's that at some point you're going to be down on your luck and you're going to have a hard time making the payments on your loan. And all the budgeting in the world won't be able to save you from this because life happens to everybody. Sometimes you need a new transmission in the car right after you fix the HVAC system in your home, which broke the week after you paid off the braces for your kid. Inconveniences will happen to everyone, including you, so just plan for it. So I think that it's a little more risky to always have this big payment due the next month when there's a more manageable option out there. If you're an older person nearing retirement though, a 15-year mortgage could be a better option for you because you probably, or at least you should, have more of an emergency fund built up and you could handle those financial hardships along the way. Not that I really get a lot of the older demographic actually watching these videos, but if you are part of that 55 and up crowd, say hi in the comments. I'm glad you're here. Thanks for coming. Anyway, that's my 2 cents about the 15-year mortgage, and on paper, if you're not considering other variables, it's much cheaper than a 30-year mortgage. Although those savings do come at the expense of less flexibility and a much higher monthly payment. Now for the 30-year mortgage, which is by far the most popular, and for good reason. First, the facts. I've already talked about the 30-year mortgage a lot in this video, and there are some implied benefits and also some concrete benefits. Because you're taking more time to pay off your loan, the concrete benefits here are that you have a lower monthly payment. And that's it. The rest of the benefits of the 30-year mortgage are implied and only as helpful as you make them to be. These lower payments though give you what I think is most important, and that's flexibility. As long as your loan doesn't have a prepayment penalty, then you can double up on your payments and effectively pay off your 30-year mortgage in only 15 years. But you still have the flexibility to make just your normal payment in case there's a hard month. And like I said earlier, we're all going to have tough months, so I think that the 30-year mortgage is better than the 15, at least just for that reason. Another aspect of the flexibility that the 30-year mortgage offers is that since your payment is lower, you have more monthly cash flow to put towards other financial goals. So you could be using your extra money to save for a car, invest it in stocks, gamble it away at a casino, or even buy more real estate. When you have more cash in your pocket on a monthly basis, you start to think more about how you can make your money work for you, and becoming a real estate investor by buying more properties can be the perfect way to do that. It's certainly not for everyone, but we know that a 30-year mortgage payment is almost half the size of a 15-year mortgage payment. And if you're young and looking to build wealth, then you might as well just get 2 properties in a short amount of time, or just get one large multifamily property where you can cover your costs by renting out that extra space. Real estate is an amazing way to build wealth because not only are you making your money work for you, but you're also making someone else's money work for you when you get a loan from the bank. The lower monthly payment allows you to take on another mortgage sooner while still keeping your old property and renting it out. And if you can stomach the extra risk, then you get to experience the appreciation of multiple different properties and the cash flow from renters that will more than make up for the additional costs that you pay in interest. Even though you end up paying more interest over the life of the loan, investing your extra cash into real estate or stocks or some other revenue generating activity will provide you with enough income that will more than make up for the extra interest expense. Because if you're paying 3% in interest but your property's appreciating at 6%, then it's worth it. Or at that same 3% interest, if you put your money into stocks and you get 8%, then that is still going to cover the extra interest that you're paying to the bank. And one last added benefit that most people don't even talk about is that because your payment is going to be the same dollar amount over the life of your loan, you're effectively going to be paying less, or at least there's going to be less strain on your budget 30 years from now due to inflation. So that $1,600 today might be a large portion of your available cash flow, but 30 years from now, that's not going to be as big of a deal. And the amount of damage that will do to your budget won't make as much of a difference as it does today. So guys, that does it for today's video. And if you've made it this far and you found any bit of value in what we're talking about here, go ahead and hit that subscribe button for me. And then go and hit that notification bell so you can brag about being the first one to comment on the next video right when it's released. If you have any more questions about getting a home loan or applying for a mortgage, go ahead and drop those in the comments below and I can make a follow-up video. As always, I love you guys and I'll catch you next time. Sydney, I love you. All right, back to work.